Hello everyone, it's Davide here and welcome back to Learning Finance. In today's video guys, we are gonna talk about a question, okay? And the question is, how much should I buy of those cruise and airline stocks, okay? Should I buy heavy or not, okay? So I'm gonna show you a portfolio representation on Excel and I'm gonna explain you how much should you buy and why. Okay, so leave me a like if you find this video interesting and subscribe to the channel, and let's begin. Alright guys, so here we are, Carnival Corporation. Here we see the graph, well, as we all know, has been destroyed with this virus, and as Carnival Corp as well, we can see American Airlines, the same, Norwegian Cruise, the same, okay? So all those kind of stocks that we know that have been destroyed, okay, during this crisis. And the thing is, lots of people they're saying, well, look at that. They went down so fast. So if they go back to previous levels, I'm gonna make a lot of profits because look at that. This is more than 300%. Okay, it's huge. Just even if we come back to the previous levels of the beginning in 2020. Okay, so should you buy heavy? Okay, because if I buy heavy, I'm gonna make a lot of profits. Okay, so that's the idea. But be careful. Okay, we have to be careful because as I showed you in previous videos, go to check them out if you haven't already. I go through the fundamentals of the cruise industry stocks, so Norwegian, Carnival Corp, and Royal Caribbean, and I go through the fundamentals of airline stocks. Okay, so Delta Airlines, Southwest Airlines, American Airlines, United Airlines, and I show you that this thing is a possibility, okay, to make 300%. But I also show you that those companies are super risky, okay, super risky. The risk is very high, the risk of bankruptcy, okay. Debt is high and the situation is not great, a lot of uncertainties, so they are risky, okay. It's not a rule that they're gonna come back to the previous levels. So you know my positions because I am invested in airlines and I am invested also, I have a position on Carnival Cruise. So I'm not the type of guy that says stay away from this, okay? No, because there is the possibility to make a lot of money on those stocks, okay? But what I'm telling you is be careful with the percentage of your portfolio. Okay, so I told you in previous videos, I told you 2 or 3 times that I have a riskier part in my portfolio. Okay, it's like I have a percentage in my portfolio which is very risky, high risk, high return, and there is a part of the money where if I lose part of them or all of them, I don't care. And that is where I have American Airlines, is where I have Carnival Corp, okay, in that part of my portfolio. Now, the key is to keep that part of your portfolio small enough comparing to the big part of your portfolio where you're gonna have good businesses, okay? So businesses that they have great balance sheets and they are not in the risk of bankruptcy in the short term, okay? So I'm gonna show you a simple Excel part, but you're gonna understand very well what I mean with this explanation, okay? So let's start. Let's say here we have our portfolio and we have is split in 2 categories, okay? So good businesses and high risk, okay? It's the risk part of the portfolio, very, very risky, where we are gonna put airlines and cruise lines, okay? In our example. And the total is 100%. Here you have the graph, and let's suppose those are just portfolio size. Let's suppose $100,000, okay, 100K. Just can be 1 million, can be 10K, can be whatever you want, okay, it's just a number. And let's suppose that the market in 5 years, so the S&P, the Dow Jones, the general market is gonna go up 100%, okay, in 5 years time. This is not something crazy, considering that since March the market has already done 35%, okay. So if you bought shares during this crisis, and the general market is already up 35%, okay, so considering 100% in 5 years, it's something that can happen, okay. And let's also consider that good businesses in 5 years, they are gonna overperform the market, and they're gonna do something like 150%, okay, as a return. And this is also probable, okay. Just consider that Facebook, which I reviewed in a previous video, is up like almost 70% as of now, okay, since March, and is an all-time high, okay, absolutely crazy. So good businesses in 5 years, they're gonna overperform the market, as they always do, okay, as they always do. So let's see what happens. Now, let's start with a scenario where I invest 80% of my portfolio in good businesses and 20% in the risk part, okay, so in bad businesses, so high risk, high return, and they can be cruise lines or like American Airlines and those things. And let's see what happens. So today we have 80 grand on good businesses and $20,000 on high risk businesses, okay, for a total of 100K. We already said that here. Now, in 5 years time, 80K times 150%, they're gonna become $200,000, okay? So that's our assumption. And the high risk, we consider the scenario where, let's say you invest in 2 or 3 high risk businesses and half of them are gonna go bankrupt, bankrupt. So zero, your money becomes zero. And the other one remains almost the same, okay? It doesn't do anything. Meaning that we consider the bad scenario. When you analyze something, you want to analyze something in the bad scenario, okay? So if it goes okay for the bad scenario, it means that it's gonna go okay even if things are gonna get better, okay? So let's consider the risk part of your portfolio, and let's consider that you are gonna lose half of it, okay? Just more 60% of it. So you're gonna end up with $8,000. So you add them up and you have $208,000. Now, portfolio against the market. Return on the portfolio in 5 years. You started with 100 and you end up with 208,000. Okay. Return on your portfolio is 108%. And the return on the market, as our assumption, is 100%. Okay, so you have overperformed the market, even if the high risk part of your portfolio has underperformed the market. This is because the high risk part of your portfolio was small enough. Okay, so was small enough. Now, why you have to be careful? Let's see what happens if you invest more in the high risk and less in good businesses. Let's say 60-40, okay? Let's say 60-40. Assumptions are gonna remain the same, and that's what we have today. Today we have $60,000 in good businesses, $40,000 in bad businesses, 100K total, 5 years. 5 years, $60,000 are gonna be $150,000, and High risk, let's say, is the bad scenario, we are gonna lose 60% of them. Okay, so we end up with $60,000. The total, $166,000. Portfolio return, 66% against the market, 100%. So we have underperformed the market heavily. We did almost half of what the market has done. Okay, and pay attention, this is just 40% in the risky part. Okay, so it's not even a half of it. Now, what I'm telling you is that sometimes I go around and I see someone that say, oh, I bought a lot of American Airlines, I bought a lot of those things. For a lot, most of them probably they mean almost 100% of the portfolio, okay, or at least 80% of the portfolio. So let's see what happens if you invest 80% in those risky stocks and things go wrong. Okay, so let's see what happens. Let's see, you are invested 80%. The red part here is the risky part. So 80% in risky part and 20% in good businesses. Let's see what happens. Let's see what happens. This is the same 100K, and your $20,000 in the good businesses are gonna end up 50,000. $80,000 in high risk are gonna end up in $32,000. Total 82% after 5 years. Portfolio return, guys, minus 18%. That means that you lost money. You lost money, and the overall market went up 100%. Okay, so that's why I'm telling you, be careful, because you know what, something it's risky. Okay, it can go high 300% and everyone is happy, but it's risky. Okay, so the probability that it's gonna end up losing money is also high. Okay, it's very high. That's why it's risky. So the trap here is that if you invest too much of your portfolio in those kind of stocks, you can end up losing money when the market is actually making a lot of money. Okay, so that's a situation you don't want to find yourself in. Okay, that's why I'm telling you this. So how much you should invest in those risky stocks? I would say, considering a very bad scenario as I'm telling you right now, I would not invest more than 20%. Okay, more than 20% of your portfolio in those companies. And that's what I am doing, okay, because you know I am invested in those companies and I actually like to be invested in those companies, but I'm not putting more than 20% of my portfolio in it. Okay, why? Because if bad stuff happens, I'm gonna end up with a good businesses part that it's gonna make money for me. Okay, even if things are gonna be bad for airlines and cruises. Okay, so that's why I'm telling you, be careful with that. Don't say, oh no, it's a trap and I'm not gonna invest in those stocks. But if that's not smart too. If you want to invest in those stocks, just do it, but be smart. Okay, be smart, and this is what I'm trying to tell you with this video. If you keep it under 20%, you're gonna be fine even if things are gonna be bad. Okay, but if you invest too much, as I showed you before, you can end up in the trap where you lose money and the market is making a lot of money. Okay, so that's not a good situation. Okay, so this is the end of the video, guys. I hope you find it very useful and helpful. Leave me a like and leave me a comment below and tell me, well, what you are doing, what part of your portfolio you are invested in, how much. Okay, so subscribe to the channel and have a wonderful day.